in GL. The exam was hard. The exam was hard. I was like, you know what? Try my best. And,
Yeah.
Anyway, yeah, I need to install some app. I think I'm not going to do that, so it's fine. I just leave it at that. Should be sufficient enough for me to do a presentation, unless you guys really want to see some live data. Gonna be fun.
Okay, you're ready. Ready.
Okay, take a week, which I expected.
This is what they're doing for their projects,
Okay,
getting distributions of all of these parameters. Prepare for the Petrovsky exercise.
I see. It's kind of like
Back test for how to eliminate losers.
yeah, it's most of very standard fundamentals.
Yeah.
That's for SP500.
Yes.
Okay.
Well, no, for all the CRISP stocks.
Okay, that's a huge database. I still remember that. We did that. So.
Well, we generally are only interested in the tradable ones
Yeah.
over a certain market cap and over a certain volume, daily
Yeah,
volume.
I think so. A volume and
That knocks it down to about 5,000 securities.
still a lot.
True.
Yeah. How many years of back test?
We go back to about 1970.
That's 50 years. I'll say something like that.
Gotta find something in that time frame.
Yeah, you gotta find something.
We are in luck today because we've got Dr. Xifan Wang from Salient Partners is going to talk to us. And he was, you were director of quantitative strategies for a while there, or what happened to that position?
Well, they require a longer working year. They
Okay.
said that they will give me the position after 3 years. That's the final agreement.
All right, well, he's been doing this job for the last 2.5 years at least, so he's pretty much ready. Well, Dr. Wang is a quantitative research analyst. He is the quantitative research analyst for Salient's energy infrastructure complex. His primary responsibilities include statistical research and analysis on fundamental and market data, as well as building new quantitative models and maintaining the current quantitative models. And so he works at Salient. Now, Salient is a hedge fund, and hedge funds typically get together and try to meet or beat a benchmark index. And Salient has several energy benchmark indexes, and Dr. Wang is doing the quantitative portfolios for that complex. Prior to joining Salient on June of 2020, Dr. Wang served as a researcher in the Department of Physics and Astronomy here at Rice University, where he got his PhD in statistical modeling for micro temperature effects of semiconductors and stuff like that.
Yeah.
And prior to that, he earned a BS from Sichaun University in 2009 and an MS from the University of Dayton in 2013. Now, I've known Dr. Wang for many years. He showed up as a student in this class back in 2018, and he just really loved the material, and he volunteered to be a TA for the next class, and so he was TA for this class 3 semesters, and then for 2 semesters he took 699, which is our quantitative finance class, and he took that, and plus he's done several computational finance projects and investigations for me as a researcher, and he's also a friend and a collaborator. So
Yeah.
I will let Xifan tell us all about SPACs. Now, if you look up SPACs in our textbook, you will not find anything about SPACs in our textbook, because this textbook was only written in 2017, and it was not known that SPACs would be the latest, greatest thing back in 2017. So
Yeah, back in 2017, we may only have 20 to 30 specs launched that year. So before I started, any student hear about the term spec?
Special purpose acquisition.
Yes, special. So did anybody trade it at all? No? Oh, yes. All right, so after today's lecture, you guys will know everything about SPAC. So this is the outline for today's lecture, and I'm gonna put the thing into 4 parts. So first of all, I'm going to explain what is SPAC, then how is SPAC structured, and why SPAC is so popular back since 2020, and what an investor can do with SPACs.
Dr. Wang, if you'd like to take off.
Yeah,
your
yeah,
mask,
it's kind of like,
I've
ooh,
heard better.
much better. Already, let's get started. So what is SPAC? SPAC is short for Special Purpose Acquisition Company. And a Special Acquisition Company basically is a blank check company. So the purpose of that company is searching a target and a private company. Then they merge with a private company and let the private company become a real public company. So the SPAC itself, just a bunch of money, it's a blank check. So we consider it as a share company. So nothing very special for the share company. They only have cash in their balance sheet. Already. So how is SPAC capital structure? So it's kind of like have, let's say here a SPAC, they want to go to IPO. So if your target is 200 million size IPO, you have to pay underwriter, which we typically those investment bank help you to fund investors, most likely a institutional investor, to help you do the IPO, because the institutional investor gonna buy the IPO shares. Then you get a successful raise enough money to go to IPO. But for the upfront, they got to raise enough money to pay the underwriter and other like legal fee. For example, you got to pay a lawyer, pay accountants, and pay SEC, all the fees to get the thing past the gold line. So typically, you got to pay 3% of the IPO size to the underwriter, and a little bit, a small fraction to the other like side. And if you look at the SPAC IPO, typically it consists with common share and warrant. But the warrant typically is a fraction of the share, or it can be like one warrant. It's a very rare case you will find like 1-to-1, but in most cases a quarter to 1/3. It's a very common sense. And also, in some cases, you find some SPACs, they don't offer like warrant. So here, if you look at what is a warrant, maybe you guys are not very familiar, but if any of you know what is the option, then you most likely you know what is warrant. Here, the warrant they issued has a 5 years lifetime warrant, from the day they IPO till 5 years. And the strike price is $11.50. It's a very standard structure. And basically means you can have the warrant, you can buy the share at $11.50. However, that is not like 1-to-100 as our normal option contract. It's a 1-to-1. Basically, if you have one warrant, you can buy one share. So when the SPAC founder have put this money down and with the underwriter and put the agreement, the underwriter will help this SPAC team to shoot for this IPO. So typically, the IPO, the sponsor company back the SPAC pay the risk capital, which I just said, the money paid to underwriter and other fees. But there's another part of SPAC. It's called the SPAC management team. So typically, SPAC management team were formed by experienced management team. Most likely are like retired big name company CEOs or CFOs or the current board member. So here I can show you some example of a SPAC like executive board. So you can see, as you can see, the CEO and the CFO or like the director are all coming from the big companies. They get a lot of experience, which could help the SPAC searching for the target and how to negotiate and get the merge deal done with a private company. And so here's another example to see like what's like a member team of this SPAC, how many experience they have, and what's the background of their sponsor. So those information you can find whenever the SPAC file the S1 for the IPO. So what's the procedure and timeline for the SPAC? So first step, you have to file S1, which means you have to submit to SEC to say, okay, we want to have an IPO, and what's the target sector, or maybe they don't have target sector. They're gonna say, we are in general, we were searching for a ABC company. Then they're gonna after the S1 filed and pass through the SEC, they're gonna working with the underwriter to raise like enough money for the IPO. After they IPO, they got a 2 years time period search for the target private company to merge with the target private company, became a real public company, and successfully go through a de-SPAC process. And in the stage next stage, they're gonna negotiate with the target company to get to narrow down the deal, get a settlement. What's the agreement between the SPAC company and the private company? So basically, they just negotiating the shares.
One question. So how is the fund used during the 2 years?
So the fund is not, it's kind of freezed during that 2 years. So the SPAC founder gonna pay for all the fee upfront to cover all the costs. Typically, the SPAC team working voluntarily because they gotta pay a fraction of the founder share, which I'm going to explain later. That's why they're gonna want to be the member, because they will be offered, if they successfully made a deal, they will offer a founder share. So that's how their economy coming from. They're not being paid for this period. So they, because as I mentioned, the SPAC member team typically are very experienced, and they get a tons of connection in the industry. They know where those private companies are and what type of target they were looking for. So it's typically depending on SPAC size and the SPAC sector they are looking for. So then after the negotiation done with the target company, they need looking for investor to raise to fund another part of the deal, which we call the PIPE deal. PIPE is short for private investment in public equity. So the reason is that because if the target company or the deal, they negotiate with the target company, and the current shareholder, or we call IPO shareholder, doesn't like the deal,
they can redeem this IPO share later on the vote day, 2 days prior to the vote day to redeem the share to exit is $10. So for example, if you buy the share, it's IPO as an institutional investor, and you think that's a shitty deal because for valuation or whatever the reason is, they don't like the deal, they can exit the position at $10. So that's the beauty of SPAC. So because that, the SPAC maybe lost most of the IPO money, so they have to raise the second money to fund this private company and get the deal done. So this stage we call a pipe deal. It's very important for most of the SPACs. Unless they have some agreement on the IPO, it happens, but not always. And then if the investor for the pipe agreed to get the deal, and we were eventually get the agreement, and then all the documentation gonna submit to SEC with the SEC to approve the deal. So eventually, in most cases, SEC gonna approve it, and they're just waiting for the shareholder to vote if they like the deal or not. But I would say in 95% of the case, the shareholder gonna vote yes for the deal. Why? Even the shareholder doesn't like the deal, they can redeem the deal. Because if they vote no, then they're gonna postpone their redemption date, which they don't like either. So they can exit at 10 as soon as possible if they don't like the deal, right? So that's why most shareholders are gonna vote yes, unless they forget to vote. It happens. It's 1 or 2 times this year, but in most cases, it's not happened. So after the shareholder vote, which is typically 1 or 2 business days, the whole SPAC process done and the deal closed. So the target private company literally became a public company as any normal company on the stock market, a tradable public company. That's it. So that's a whole procedure and timeline for SPAC. So I have a picture of how the process works. So typically, most of SPACs, they are asking for 24 months lifetime for the SPAC to searching target. But some SPACs, they have very strong confidence. For example, there's BlackRock launched several SPACs. They think they can get the deal done within a year. So just saying our SPAC lifetime only have 12 months. So that's very attractive. So which means in maximum 12 months, you can get the money back as an IPO investor. So as I mentioned, in the IPO stage, typically offered as a bundle, as a unit. So the $10 is paid for is buy for the units, not only the shares. So that warrants worth some money. So actually, you have a discount on the total bundle. That's why you can get the IPO investors. Then, so here's basically what's a flow chart illustration from what I said in 2 minutes ago. So typically the lifetime 24 months, and you get roughly, if you're running out of time, you got to be hurry. But in some case, actually in the most case, they cannot finish within 2 years. They're gonna ask for an extension. So the sponsor team gonna ask, they were willing to pay some money to extend for another 6 months or 12 months. So, well, yes, most shareholders gonna say yes because they gotta pay for that. So, which is a good deal for both sides. If the 24 months is end and they cannot find any target, they have to liquidate all the trust fund and redistribute back to all the shareholders. So, which means they're gonna completely lose their risk capital. That money just gonna gone. So that's why they're gonna pay for money to extend it. All right, here's some example for a very popular social capital SPAC. They are already gonna be in SPAC this number 4. Okay, so basically you can say they are targeting for a 350 million SPAC size, IPO size. and which you convert as like 35 million unit. So each unit, I can't remember exactly how much warrant is involved in the thing, but it's most likely going to be a quarter of the founder of the share numbers. So that's that's the front page of the S1 referred to. That's not the front page, the second page. And this table, you can see it's very detailed. You're going to talking about the member team, and you have the proposed business, which means what type of company you are looking for, or what type of industry you're looking for. And you will talk about your management team in this file as well, and some benefit, what type of like economy those management team and founder, the sponsor are gonna get after all. So it's very detailed. If you have time, you can look at that. I've been iterated through a bunch of those this year. So here example, like they are talking about like what type of company they're looking for. You can see the bullet one are in the technology industry. So, and as you can see, they are specific target for like technology sector. So you can expect what type of company they would looking for. Sometimes it happens they are targeting for a one sector, but end up doing the other sector. So a very famous example is DraftKings. So the initially SPAC companies are looking for cannabis company, and they cannot find a target, so they end up to merge with DraftKings. But that's a very successful merge. The DraftKings is traded somewhere between $30 to $40 right now. So they basically was triple their like value from the IPO, which is good for them. Yep. All right. Then if we look down and here go to the searching target stage. Maybe it's too small, you cannot see it, but in the bottom line is a closed deal, and the second bottom is the announced deal. You can see that's a lot of like private companies already being jumped onto the open market through the SPACs. So the very bottom you can see that's very popular on the riders. As you can see, most are like investment bank. Yeah, they've done a lot of like SPACs this year. They make tons of money on the writing fees. And on the top one, you can see like there's different SPACs are looking for private company right now, and they have divided them by different like size. So normally you would have a SPAC size is 200 million to 300 million. It's a very standard size, because if the larger the SPAC size, you are the larger the private company you are looking for. So typically on a 200 to 300 million SPAC size, you are looking for company valuation at 1 billion to 2 billion. And if you are looking at a larger SPAC size, you might looking for a very big private company, which is tough to find a target. And if for some of small SPACs, you can have only 60 million SPAC size, and you are looking for some tiny company for like, tiny compared to the others, maybe only like 200 million to 300 million company value. So it's a typical. So we have debating, right now on the market, there are still like over 400 SPACs searching for target. Is that enough private company for them to searching for? The answer is yes. Actually, if you look at the pool, it's much deeper than we thought. Right now, I would say only 10% to 15% it goes above the water now. Still have a big chunk of like private company, especially in US. So it's plenty of target like selection they can target for. Yeah, go ahead.
Why do these big investment banks want SPACs?
Why?
Yeah, like first of all, what does it mean when there's a company on here? Does that mean like they had a successful SPAC or something?
Oh, successful SPAC means they get the deal done and the process done, And this is successfully, the private company goes through a SPAC procedure and became a public company.
So they did the whole process themselves?
No, those underwriters, they are just help the SPAC team to like hook up with investors. That's their job. That's why they paid for the underwriter fee. That's why they get the risk capital.
But who's like organizing the raising of money to begin in SPAC? Is that?
It's so for the founder share, it's a small group of investors. For example, some private equity fund, if they want to rise up a SPAC and they want to turn one of their invested private company goes to public market, they can do that. And they can rise up the risk capital by themselves, or they can using their network to find some big sponsor to put up the risk capital. Then they will go to one of those underwriters to say, hey, now I need your help to get me go to the IPO. So then they pay for this underwriter, and the underwriter has huge connections because we are clients of Citi, we are clients of Goldman Sachs, we are clients of Morgan Stanley. So whenever some SPAC team goes to them and they will like call us, hey, we have a SPAC, they want to go IPO it someday, and you guys interested on that? Then if we say yes, they will hook up together to see what's the like term of the IPO, what's the structure of the IPO, and we then determine if we want to invest on buy the IPO share or not. So basically, that's what their job is.
Great. So all those on the bottom are like the ones that are supplying the money.
Those one not supply the money. This one just investment bank. They help the SPAC team go to IPO. Is that clear? Okay. So this just give a idea how many SPACs are on the market and what's the typical size. But don't worry, I will have some statistics analyzed in the following pages. So when they have the private company and get the negotiation done, they were looking for pipe investment. So typically, they are looking for, in earlier this year, they're gonna looking for like 200 million to 250 million size for, on average, for the pipe deal, but sometimes can be high. For example, a Lucid auto company has a huge pipe deal and have a insane valuation. I will talk about it later, but not now. I will give you an example here. So that's how the pipe deal goes. As you can see here, that's Athena SPAC and merged with hydrogen. Basically, hydrogen is like a disruptive renewable technology company. They just converted the solar energy to heat and make that. And look at the pie chart is how the share structure gonna be afterwards, after the deal or after the deal close. Ideally, they make an assumption here. So if the SPAC IPO shares, that's 250 million wise shares not get redeemed. They're gonna take like 10% or 10.4% of the total share. And the original private company gonna have like 77% of the total share. And the sponsor team here, that's what I'm talking about, why they want to launch IPO. The sponsor gonna get like 4.3 of the total share. And the pipe investor gonna get like 8.3% of the total share. Okay, that's why the sponsors are motivated to do that. And it's and you can see that it's gonna be a big chunk of like cash added to the balance sheet, which gonna boost the company to do R&D for next couple years until they get a very successful like a production land be built or etc. to grow big enough to can like do as a real public company. So most of those SPAC target company need big chunk of cash to like support them for next 2 or 3 years, could be 5 years, to develop their product to until they can deliver the product. Most of specs. There's very few specs like merge with a very mature industry, more like a value trade, not a growth trade. They are more like already have positive EBITDA or positive free cash flow, etc. Something like that. But it's case by case. I will talk about that in the later discussion. So I will give you a case study here to talk about like a specific pipe deal with investors this year. So we've been hooked up by, I can't remember, it's Barclay or one of their underwriters. So basically, the target company is Archaea Energy, and actually they are merged with 2 companies. One is Archaea Energy, one is the other company. So it's going to be a very interesting deal, Archaea Energy. So basically, the Rice acquisition company gonna merge with 2 private companies. This is the deal, how the deal looks like. So basically, on the left top corner, you can see that's the Spec team, and the bottom is the company, the private target company team. So basically, we have a Zoom meeting with both teams. We've asked a bunch of questions about their product, everything, etc. So basically, on the right part is valuation and the multiple number for this company, and it is a very good deal, I would say. And if you compare the valuation to their peers. So if we scroll down and see, so the target company is very. So this is basically some financial data to see how the pipe is structured and how what's share allocation are, and what's the value are, and how much money gonna add into their balance sheet. So I will talk about this company. This company is very interesting. It's a renewable natural gas company. So what this company do is, so they collect methane from solid landfill. So basically, if you put those waste into a landfill, and it's gonna generate methane over time. So that's what they did, and they collect those methane, make it purified, and deliver it to the target company to whatever they want to use, either heating or like doing to generate electricity. So that's a company. Why it's like why this thing is very profitable? I can give an example here. So if you notice, who knows natural gas spot price for now? John, do you know?
It's been going up the last few days.
A lot. So the natural gas price is slightly above $5 per MMBTU, but whatever those guys collect from land, even though you think it's free, but they have to purify it. They have some costs add on to that. So the cost actually for them is around $8 to $9 per MMBTU. But why I said this is a good business is because government gonna pay a credit to whoever buy the renewable natural gas from them. So they can sell that thing for $38 per MMBTU in California. So that's why it's a fantastic business. At least for next 5 years. I wouldn't say California gonna change your policy on that. So yeah, so that's so basically the company has a free cash flow and positive EBITDA from day one. It's the operation. So here is just on 2020, the number is pretty much in line, 40 million EBITDA, and their operation and the current projects are all over the nation. So. I'm not going to talk about the detail of that because I'm not the management team of that. I don't know the detail, but I only know I did the math. And if they are big, largest projects so can work in within their timeline, the 24 number is very realistic. So it's a great business. So here just some idea. You can both get from the renewable natural gas from solid landfill and from the farm waste. But the solid landfill is easier because those waste management company always put the thing into a fixed spot, so they can build their factory next to it, and one large landfill spot can provide 30 years to 35 years simultaneous renewable natural gas. And the production gonna peak after year 5, and will be maximum during year 5 to year 20 and slowly decay. So that's how the thing goes. And in fact, there's a lot of landfill site in the nation that's just being landfill. They didn't do anything on that. So there's tons of opportunities for the company to sign contract with waste management company and do the business. All right, the problem to collect waste from farm is that you had to, those farms all are isolated all around different areas. So you have to collect them to one spot and with them to turns into biogas and collect methane from that side. So because the transportation cost is economy-wise is not very high, so they rather do a solid land filling rather than from the farm. But either way, you can do that. Some companies do that, and I'm not going to talk about that. It's just talking about how many waste U.S. produced per day or per year, and that's a huge potential for collect renewable natural gas from landfill rather than you collect from fossil fuel. So basically, the global warming is the thing, and most countries is pushing hard on the renewable side and doing carbon neutral. So so those type of projects are gonna have a tailwind from the policy. So long run, so it's gonna be very positive in a long term. But also in fact in short term, they are already making money from day one and EBITDA positive. To be honest, I saw a lot of deals. They are talking about 27 numbers. It's kind of ridiculous. So giving an example, there's a company called Solid Walk. It's they're trying to manufacture solid state battery, and for the EV company, and they were talking about they told me we'll not be able to produce product until 2028. I'm like, you're bullshit, and you're looking for a big chunk of money. I don't know if you guys can survive until 28. That's what I said. So that's a big no on that. And so there's also some crazy company. I can give another funny example. So if any of you watching football, you must know the football star Peyton Manning and his brother Eli Manning. They sponsored a Spec team, and they're going to merge with a grill company, a barbecue company. It's kind of interesting. So all the crazy things goes on Spec space. But for this case study, it's a very decent company because the original Spec management team, they've doing the business in the in the midstream, which is they doing a lot of pipeline business for years and very successful. So here just some carbon dioxide calculation and what their score can get from renewable natural gas on the landfill versus other resource. So they're just saying we are targeted for carbon neutral and etc. So this I'm not talking too much about this thing, and I just go that it's just a forecast of the how much U.S. gonna waste. They're waste gonna goes up, and how much landfill gas can collect from them. So it's a big chunk of that, and we can see the numbers is still keep going up. So here is just some database of this existing natural gas infrastructure, which that's our main business. Our company doing a lot of midstream pipeline infrastructure investment, and that's our mandate. So we are very familiar with. So basically, they can. It's just showing you they can pretty much collect natural gas from all of the nation and deliver it to whatever the target their client are. So that's very mature business as a gas pipeline. And this shows how much company is very support on the or doing business or trying to investing into this renewable natural gas industry. So it's just some tailwind and shows the confidence that they are very confident on this deal, and they trying to make the investor feel very comfortable on their pipe deals. So it just shows what's the demand from the current and the future, and how much they can provide. Okay, it's just some random things here. So here just give example of the management team from the two energy company and the SPAC management team shows how much what's the experience they have, and how they can ensure it's going to be a very successful pipe deal or investment. So, but all the SPAC's management team going to say it's a good deal, but in fact, I would say 80 to 90% are shitty deal. So that's the reason, because first of all, this private company, they want to maximize their the shares within this pipe deal. So the valuation most time will be high. And also the private equity firm backed these private companies, they want to maximize their profit. So that's just a negotiation between the pipe investor, the SPAC sponsor team, and the private company team. So they just so each side want to maximize their profit. So it's just be problematic later on. So I will talk about why it's became problematic later on next, not after the case study. So here they just mention how what's the numbers they can get. Okay, they get already existing 30 existing project and some other projects on the growing, and their biggest project in, I think, in Pennsylvania or somewhere, they can produce a big chunk of revenue for the company, and they already signed a fixed price contract for the 3 clients, and for a couple of years. So as you can see here, what I mentioned here, the D3 ring price is what the governments pay for the credit. So it's just very high. So you can convert this price into the renewable natural gas. Means if the D3 ring price high, means this renewable natural gas price high. This is actually tradable on the market. Actually, by the way, I just say something like European is trading carbon credits right now, and this thing goes up because they got a mandate to force the company to be carbon neutral at 2030 or 2035, and the company had to buy those carbon credit to produce excess carbon. So they had to buy it. So the carbon credit prices goes up a lot. And since government is gonna issue the carbon credit less and less year by year. So here they just says they already have some fixed contract with their big clients, and to ensure their price is not driven by the commodity price a lot. They're gonna have 60% or 65% of the supply already contracted, which means the price is fixed. As you can see, they fix it $20 per MMBTU, which is almost double their cost, and that's for 10 years contract. And they also expose 35% to the commodity price in case the price keep going up, and they still be able to capture the upside of this opportunity. So overall, that's one of the great investment overall in the SPAC space. So here they just mentioned what's their factory gonna looks like. They get a very successful experience building those renewable natural gas facility. Is the best in class. Okay, I'm not going to talking too much. I will jump to the financials. So not like a traditional IPO company. That's one major thing. SPAC company is different than traditional company. Traditional IPO is they use a long-term projection to show their financials. Basically, all like a model of prediction. It's not like realized yet. But for most of the traditional company, you have to show your past 3-5 years like statements. So you cannot use that projection to like for the IPO as a traditional IPO. So, but for SPAC, you can. So that's why you will see sometimes you can see this compound growth is 38%. As what there's a autonomous drive company, they're talking about their like a compound growth rate at 1,000%, which I don't believe, and I will like you guys are bullshit, and it's not possible. So so basically you just gotta be careful on those numbers. I always give them a huge discount on those numbers. But for this company, you can see they already have positive EBITDA, but their free cash flow is negative because they are keep building the new facilities. Once those projects are done, they will turn the free cash flow to like positive and like generate dividend after 3-4 years, which is very good for the most of those investors. And that's just their revenue projection. The same thing for the EBITDA projection. And then now I'm going to let you guys look at the comparison of this company to the peers. Okay, that's first of all, he compared the company with the other like a more like a recycle company. They both doing the renewable plastic, which you collect the plastic from waste and reusing, and how much EBITDA they can produce. And those is very important. They compare their like revenue and EBITDA projection to their peers. The other three company are all like a renewable natural gas company. I'm not quite sure about the second company, but the Clean Energy and the Montauk, they both doing the renewable natural gas. If you look their share price, it just goes up a lot since last year to this year because of the Biden administration pushing very hard on the renewable side. And here the numbers compare like land by land compared to the others and some of the disruptive technology. Yeah, it's like they even put the Beyond Meat in that, and the Plug Power, which is a hydrogen fuel cell company. It's kind of like a very interesting, but the most important is how you gotta compare it with their peers to see the valuation are. And we found out it's kind of like a low valuation compared to the peers, and it's a good deal. So we end up I can't remember exactly number, somewhere between 15 million to 20 million investment on this past year. We asked for like 30 million, but we get cut back to like 20 because everybody want to invest in it. The pipe book will be oversubscribed by 2 times. Yeah, and they only take like, so everybody get a haircut. So it's end up being a very good investment for us. So let's move back to the SPAC. I gotta speed up, I think, a little bit. So here's what happened after the PIPE deal was negotiated and settled down. So it typically take SE 3 to 5 months to go through their process to get the merger approved. In some cases, can go above to like a year. If you look at some of the specs, they are be struggling on this process for a year, over 250 days. But on average, I did statistic analyze the medium number is 150. The bottom quantile is 120 days. So most company was the way can finish the process in 120 days to 160 days, which is 3 to 6 months actually. And if everything goes well, there's no fraud or the misdocumentation in their documents or statements, the thing gonna approved by the SEC very quickly. I would say 3 to 5 months, and they will get a green light and set up a vote day, and this SPAC became a real public company. So now I'm talking about why SPAC is popular and who will get a benefit from that. So first of all is the sponsor economy. So as I mentioned earlier, the sponsor can get a big chunk of the share after all. So that's their motivation to do the SPAC. And but they have to lock up their founder share for 1 year, which means from this SPAC day, they have to wait for a year to lock up their founder share. But there are some exemptions. So if the share price is trading above a certain level, they can unlock earlier. So the faster you can unlock within 3 months. But in order to do that, the share price have to trade above $18 for 20 days. That's a very standard case. If the share price can trade above $12 or $13 for 20 days, it can unlock for like within 9 months and 6 months, respectively. And warrant is a bonus for the SPAC IPO investor. So they can, so SPAC is very interesting. Whenever they IPO as a unit, but after, I can't remember, either 47 days or 52 days, you can separate the unit became share and warrants. So from then, you can trade warrants separately, and you can you also can trade like a share separately. So typically, they're gonna do what they're gonna do is some hedge fund does that. So after 52 days, they sold out the share. They keep the warrants for some surprise. So normally the warrant price is gonna jump up if the SPAC company announces a deal. So normally a SPAC warrant is gonna trade below $1. Typically they trade at 70 to 80 cents. And once the SPAC company announces a deal, the warrant price can go to like $1 per warrant. So that's like 30% return in a day, which is amazing, and they definitely gonna keep that. And for the share, is sometimes the share, when they're gonna announce the share price could go from 960, 970 to like 990, somewhere closer to $10. So they want to get a big jump on the common share. They get a big jump on the warrant, so they will keep the warrant. And because the volatility, the volatility jump on the price share, so the share price and the warrants, of course, goes up. And also for the private company, they can have a cash boost for their business. Also, whoever founded the private company, most are the private equity firm, they can exit with a gain. So it's very sneaky play. Those days happening a lot is you can see there's a lot of PE firm, they launch a SPAC, they merge with private company they already funded. So they can exit, they can cash out and take a big return rather than fund the private company for another 3-5 years, which is good for them because they want to recycle their cash to do a new investment. That's typically. But in the beginning of the IPO, they have to say on the current, we don't have any target, but in reality, they already have several potential targets. They know which company they should be looking for, but they cannot say that publicly. So that's the idea. So here, let's compare SPAC with the traditional IPO. So for the SPAC merger, I called these SPACs the real IPO for the private company. For the SPAC itself, it's just a blank check company. It doesn't have anything except cash. So it's not a real IPO. And for the SPAC merger process, typically, as I mentioned, it's 3 to 5 months. But the traditional IPO, it's a lot longer and sometimes can even go to like years for IPO because the company is big and has a lot of documentation you need to clear out for the SEC to review. So it's kind of like a pain in the ass to go through a traditional IPO for a lot of company. But also typically they will pay a higher underwriter fee for the underwriter. But for the SPAC, they pay less. They pay like typically 3% up on the SPAC IPO. Then they pay rest over on the de-SPAC. When the de-SPAC process goes, they pay the rest of that. So they don't need to pay the big chunk of money upfront. So here just some comparison. You guys can read the detail if you look, but those are the major difference. And what's the upside for the SPAC? First of all, is speed. So typically, because SPAC only have 2 years lifetime, so they have to do it very fast. And the SPAC merger process only takes 3 to 4 years, and it's very friendly for most of those small companies. And they can, because the SPAC team always formed by a very experienced like CEO or CFO, so they can partner with, sometimes they're gonna partner with the target company to help the target company to be a real public company, because a lot of those private company, they are like executive board don't have experience to how to lead a private company, which is different than for the public company, which is different from the private company. It's quite different. But the SPAC member team has a lot of experience how to deal with this investment relationship, etc., how to run a public company, so they can help with them. And the other thing is they have the redemption option. So as I mentioned earlier, as an investor, no matter what stage you bought the share, except a week prior to the vote day, you always be able to redeem the share with $10 exit. So it's very safe for most of the investors. So that's a strategy lots of the hedge fund doing is, if they found any SPAC the share price be beating down a lot, they just buy it. And they just waiting to the vote day, they just redeem it. It's very simple. You can crank up 2-3% return on that side because they typically do a big size, so still a decent amount of return for them, and almost no risk on those deals. So it's more like so in my point of view, it's more like you buy a treasury bill at a big discount. That's it. And for the investor, you most likely a lot of investors can potentially invest in some mid-early stage private companies. Now, even though they became public company, so one of the very popular SPAC startup company is it's Virgin Galaxy. So which they are doing, if you hear about them, they are doing this space tour. And the ticket was, I can't remember, it's like 300K per ticket and travel to space for 30 minutes or 1 hour. That's a tour. And the company is still like doing the, it became a real commercial yet, but they already sold out a lot of tickets. So for the investor, so for the retail investor, they get opportunity to invest those type of company, which normally you can't because typically only like a private equity company can invest those companies. They don't accept small like investment most of the time. And for the sponsor, they can like have a big chunk of share afterwards, so they can potentially they are like on the average the sponsor share price is $2. So let's assume if the share price can hold up around, let's say $8 after a year, so they make 3x return on their like initial investment, which is shit tons of money return on 3 years. Yeah, that's why the sponsors are willing to do that. So some of the disadvantage for the SPACs is like sometimes the sponsor can be very poor quality. As I said, a lot of like inexperienced guys do. I hear even some basketball. Go ahead.
Oh, I don't want to, on that question on the previous slide.
Okay, sure.
So like, explain redemption options again, like, so compared to a traditional IPO with.
Yeah, so traditional IPO, if you go to IPO, there's no flaw. They can sink from day one. So if you are the shareholder, you only be able to sell it in the market. So, but for the SPAC, if you bought a SPAC, let's say $9.90 per share, and SPAC goes down to like $9.50, which not going to happen those days, but it could happen during the crash, and you still be able to, when this SPAC date or the shareholder vote they set, you still be able to redeem your share. You tell them, I want to redeem my share at $10. They have to pay you $10.
Wait, that's even higher than $9.90?
Yeah, exactly.
So you don't have any liability in the company?
No.
And you can say whatever price you want?
No, you have to like, you only can be redeemed at 10, it's right in the S1.
Wait, why is 10 the cap?
Because that's a trust value. The trust value is $10.
Trust?
Yeah, so basically that's IPO size money. So they raise up, let's say they raise up 200 million for the IPO. That money they are put into trust, and the trust is buying the treasury bill. So it's just that money is just very safe. So that's the value. You only can redeem it at that value. You cannot redeem it at $11 because the trust value is whatever the trust value is.
Is it always 10 or is it?
Typically, it's sometimes 10-01, 10-02. It happens. I will discuss it later. Nowadays, because they want to attract IPO investors, they will put like a 10-01 as trust value. Some extremely cases they put 10-03. So when you redeem, you can do like 10-03.
Even with 3 cents?
30 cents. Oh, sorry. Yeah, 10.30. Sorry, like 10.30. Yeah.
And then I have a question about the warrants. Like,
the warrants, you cannot redeem the warrants. You can access the warrants. It's a strike price.
So are warrants only having to do with SPACs, or do warrants apply to like other?
Some, John, is that any warrants for the?
Yeah, there
very-
is in our book, under warrants, there are
Yeah.
like options.
Yeah, it's not very common, but it exists.
They were back in the 60s.
Oh, very. Nowadays they do like option. That's kind of funny. Yeah, people are buying those back like options rather than warrants, which warrants way undervalued back in like February this year. So that's the case. So now I'm going to talk about downside SPAC. First of all, is you can have some very inexperienced management team. They'll not be able, or like a sponsor team, you cannot be able to find a good target on you even cannot find a target. And second, the most problem is just the very shitty target company, and you are not be able to find target. That's the most downside. But for the IPO shares investor, you're fine. You're not worried about that. Though that's the stresses to the sponsor team and the management team. So since this is a statistic class, I'm going to take on some statistical specs. So as you can see, earlier this year, we get some friends of this spec booming. It's crazy earlier this year, especially in the January to February period. A spec, when they get IPO, the price of that unit goes up from $10 to $12 for no reason. It's just within 1 week or two, the whole unit price jumped to like $12. So our firm have been participate a lot of IPO. We just flip it. We buy 10, and after 2 weeks it became $12. We just sold it. Why not? Because they didn't do anything yet. It's just a blank check company. So they're supposed not going up, in my opinion. Now, after the March correction, everything crashed. As you can see, the share price is like the return actually is like going down, and most likely is now it's have a discount now, which is should be normal. So here, look at some numbers. 2017, yes, only 34 SPACs goes to IPO. And if you look at back, prior to like 2020, that's almost not much SPAC goes to IPO that prior to like 2020. And after 2020, that's a booming on SPAC. And if you look at the SPAC market, there's roughly around 30 SPAC goes to IPO every month for now. And there's still like over 200 SPACs filed S1, and it's on the runway to launch IPO. And over 400 SPACs are looking for target. There's 120 SPACs already announced they found the company and they get the PIPE deal done and waiting for the SEC to get them green light. And there's, let me see. Yeah. So this is some numbers to see what different stage on the specs. As you can see, yeah, it's more than I thought it would be 300. The 306 specs filed for IPO, and because you have to add up from 2019, 2020 number up to like 2021, so you have like more than like 400 specs searching for target, and roughly above 120 numbers have already announced the deal, and there's a lot of complete. In fact, you emerge, there's a lot of specs gonna be liquidated, only like 6 specs get liquidated. So the odds they cannot find a target and have to redistribute the money back to the investor is very low. You look at that. So the risk for the sponsor is kind of low. And yeah, that's how many deals you count on that. So an average SPAC size, as I mentioned, typically is somewhere between 200 million to like 300 range. That's a typical range for SPAC. Because most private companies, the valuation is 1 billion to 2 billion wise. That's a SPAC size for. And here's the SPAC IPO versus the traditional IPO. You can see for this year, we get SPAC IPO much more than the traditional IPO. And last year, SPAC has already taken like 55% of the total IPO in the US. And you can see a big chunk of money has been raised through SPAC versus the traditional IPO. Yeah, it's kind of like a half and half on the money-wise. On the number-wise, the SPAC is much larger. And by the way, that's a performance I pulled out from Bloomberg to say that's top underperformer and the outperformer for the SPAC. Lots of SPAC has been like knocking down a lot. The QS, the QuantumScape, it's like a solid state lithium battery company was being short squeezed up to $120 later last year and being keep declining to $20 today. And that's some other like a good quality name, as you can see, like STEM. It's like an energy storage company. Some other company goes up to like $30, but the number changes. This is I pulled from May, I think, late May or June. I can't remember it, but I did another report on that. So now I have how many minutes? I have 10 minutes left.
Yeah.
Yeah. So now I want to discuss with you guys the future specs and what investor can do with specs. So I think currently you will feel like the market already turned. So initially in the last year and early this year, it's more like a buy-side market. So everybody want to get a deal with SPAC. Now there's too much SPACs on the market, like looking for target. So the odds they're getting a good deal is very low. So because if you are a private company, you can shopping for a SPAC give you the best deal. So that's a dilemma to launch a SPAC for now, but that's case by case. For example, if you are very strong private, like an equity company, has a bunch of private company invested, like BlackRock or Apollo, those kind of big firms, they can bring up their own private company to the market easily. And they can bully on the small SPACs. Actually, that happens. So we know that's a SPAC called the ticker name was SOAC. It's called Sustainable. It's the first renewable SPAC, and we're very familiar with the SPAC management team, and they are very close to get a deal done with a solar company, and then Apollo step in and force Goldman Sachs to take the deal to them. They can do that. Basically, they just said, hey, Goldman Sachs, we're doing like a billions business with you guys every year. If you cannot help me to get a deal, we will go to other firm. And of course, Goldman Sachs can do that. Yeah, that's SPAC. So, but for the investor, what you can do, so you always can buy the share on the $10 and redeem at 10. So I would say if you are like a very conservative, you just target for a low percent return, better than bond. That's a way you can do, and almost no risk. Basically, I call SPAC redemption. You just buy a treasury bond at discount and redeem it. You can make like 1 to 2% in 3-5 months, which you not be able to get from the treasury bill. And that's pretty much about for the retail investor. And for the institutional investor, they always can get involved in the IPO, so they can get like $10, 10 cent, $10, 20 cents deal and flip on the IPO day. They can knock up like 1% return on just in one day, which is great. If not, you may also be able to get 50 bips return in a day, which is still a decent amount if you do a like 10 million IPO, something like that, 10 million IPO shares. So for the pipe size, valuation is very important. Earlier this year, almost all the company, the pipe deal is highly valued. It's very overvalued. So it's crazy. That's why you can see a lot of those shares being knocked down a lot. Some of the SPAC already dropped more than 50%. You will see some of them they announced earlier this year, and these SPAC only in May, and the share price only $4 now. It's already dropped 60%. Yeah, it happens a lot. because valuation is so high and the company on the first quarter report is missing their target. They cannot deliver what they claimed and the share price. Yeah, if you have any questions, I'm waiting to take any questions.
Well, let's thank our speaker. And go ahead.
As you mentioned, you said that the SPAC will take a lot of cash and freeze them. So is it legal to use this kind of a huge cash flow to make investment?
No, you can. So basically, they'll only be allowed to buy the T-bill. It's the US T-bill, the short-term T-bill. That's the only thing they can do. Because that money is freezed for those IPO investors or whatever who became the IPO shareholder. It doesn't matter. Those money is just secured and being locked up. They cannot use for other things.
Second question. So if, for example, I saw some SPAC with price lower than 10.
Yeah.
So does that means that I can buy it probably at a 9.7 and redeem it before the?
Yeah, you can do that. So typically you do is, we have a SPAC income fund. What we're doing is we're looking for those announced deal. And if the thing been knocking down a lot, let's say in some cases you can find a deal for like 980 and you just buy it and redeem it 10.
So what is the deadline that you
buy it? You will get notified by the broker. So whoever is your broker, whenever they receive the notification from the SPAC company, they will send to you. And you will read the notification and say, okay, they will set X, Y, Z day, and you have to redeem, typically the redemption deadline 2 days before the vote day. And if you want to get a firm tender, you have to do a week before the redemption deadline. Let's say if the deadline today, you have to tell your broker, I want to redeem the share, typically five days before that, 5 trading day before the redemption deadline. Otherwise, if it's too close to the redemption deadline, you only can get a best effort, not the firm. Well, yeah, no problem. Is there any other question?
Have you made a lot of money from SPACs?
For me?
Yeah.
No, we are not be allowed to trade it as if you're working for any investment firm, you have to hold your shares for at least 30 days, and you cannot trade them within 30 days, and we cannot trade any stock that a company hold. Let's say if my company bought Apple stock, I cannot buy Apple stock in my personal account.
What about some separate ones that your company doesn't buy?
You can, yeah. If it's not on the
Have you tried that since you know so much about it?
I didn't do any redemption. I have better strategy because I have some other strategy can generate a much better return, so I don't do this.
So you don't do SPACs personally?
Yeah, I don't do SPACs personally.
So what do you do that's better than SPACs?
Most likely, I would say long-term investment, more likely I would rather do SPY rather than SPAC. Yeah, SPY provide a better return. Yeah. Currently, all my 401k money is all in large cap companies, and some in bond, some mostly in SPY. That's it.
He's got a bunch of stuff going on in other areas, I will tell you that.
Yeah, which I cannot tell now.
Is SPY like the index fund for S&P?
Yeah. SP 500 index ETF. Yeah. So if you want to do, you just and later you can just invest your money into SPY. That's very simple. You just wait for every month just have some money thrown into that, and after 10 years maybe you compound like 150% return, etc. Something like that. It's very likely gonna happen because in the long run economy gonna grow anyway.
Xifan, I really appreciate this glimpse into SPACs and how things are traded at the institutional level.
If you look, click on the Bloomberg, who is the biggest holder for the SPACs? All like hedge funds. Yeah, so they basically, I personally know like some of the funds, they make a lot of money. So what they do is they, because the booming of SPAC, they just buy IPO, wait for the announcement, sell everything. That's it. It's very simple. They just make up maybe the annualized return is 7 to 8% for their unlevered. If the leverage consider the borrow rate, you get consider interesting, you might get like 10% return annualized. There are almost no risk, and they get like a 1% management fee plus 10 to 15% performance fee. So that's big money for them. Yeah, that's a firm called West Spring. They only have like a four people team. They made 20 million last year on the performance fee.
On fees,
Yeah, on the performance fee.
and they like part hedge fund.
They only have 4 people manage like.
Yeah, it is a hedge fund.
Yeah, it's kind of hedge, but they don't do short. They only do like long. They long only.
Obviously, they have a lot of money to work with.
Yeah, they get on 2019 they said they only have 50 million, but on the annual like actually earlier to 2021 their fund goes to 2.1 billion. Yeah, and they charge like 1% of that 2.1 as a management fee plus 15% from whatever they made for their clients. If they made
Steal
well.
compared to 225.
And they only have like 4 people. That's how I get amazed.
So we made a lot of it off of SPAC.
Yeah,
Just buying it pre and then after IPO and selling it.
yeah. And now they said they wait until announcement.
Well, you guys are free to go unless you want to hang out and talk about SPACs some more.
It's just a crazy one.
This was beautiful, Xifan.
Thank you.
Very nice job. Very good.
John, are you gonna share the slides with us?
Yes, we will.
You're gonna post it on like files?
Yes.
Did I say that?
Have you done